Hello everyone. Today I'll be presenting a strategic M&A recommendation. Broadway Industries' proposed acquisition of Landmark Facility Solutions. This transaction has the potential to reshape Broadway's national presence, but only with the right price and financing structure. I recommend proceeding with the acquisition with two key modifications. First, negotiate the purchase price below the current $120 million, and second, adopt a 50-50 debt-to-equity financing structure. Using the synergy calculations table, we can see that the merged companies created substantial synergies in the base case, with over $143 million of total value added, and a 55% increase in value for Broadway. This helps transform both companies' competitive position and growth trajectory in the facility services industry in the US. However, in the pessimistic case, there is a value destruction of $17.19 million to Broadway, meaning that there's possibilities that this acquisition could be unsuccessful. But when we consider the growth potential and operational efficiency which the acquisition can bring, and the significant increase in value for both companies in the base case, it shows that Broadway should still go through with the acquisition, but with slight modification to the deal. Let's take a closer look at this. At the current offer price of $120 million or $30 per share, Landmark's shareholders see a huge uplift from the standalone value of $6.62 per share. But according to our share price table, Landmark's fair value in the base case is $34 per share, and in the pessimistic case, it drops to just $19.55 per share. That's a 353% premium over the standalone value, and if projections slip, Broadway shareholders could be left with a loss. Further, we can see from the pie chart here that there's a significantly more percentage of value added to Landmark instead of Broadway if the acquisition goes through. I've created a football field chart which uses P to E ratio and implied DCF to give a rough estimate of Landmark. The inflated EV to sales multiples are excluded to produce a more accurate valuation of the company, and we can see that the purchase price of $120 million exceeds the estimated value, especially when we look at the sensitivity table of Landmark's standalone value here, where it's only $26 million, even under the optimistic assumptions of a 4% growth rate, way above the projected 2.5% US growth rate in 2015. And even a 0.2% downturn in the operating margin could result in a decrease of up to $10 million off the company's value. This gap between intrinsic value and offer price poses a serious risk in a pessimistic outcome. So again, our recommendation is to negotiate the purchase price down to around $100 million, as estimated from the chart. Now on to financing options. We were given two options, 100% debt at a 5.5% interest rate versus a 50-50 debt equity mix, equity investment provided in exchange for 40% ownership in the combined firm. 100% debt gives a higher return on equity, about a 3.76% advantage, but it also introduces significant leverage and refinancing risk, as its debt-to-equity ratio of either 1.34 or 1.49 is significantly higher than that of the 50% debt option seen on the table below. Because of this, the 50% debt financing is the safer, more sustainable option, even at the cost of some dilution. Let's take a closer look at the 50% debt option. We can take a look at the interest coverage chart. It more than doubles in the 50% scenario compared to the old debt scenario. This applies to solvency ratio as well, with 50% debt cases have a much higher value, indicating better long-term viability and reduced dependence on debt. Using the comparison chart, Broadway's key credit matrices are significantly stronger in the 50% debt structure, with the D to E ratio under 0.5 by 2019 and interest coverage above sixfold in the base case. This financing structure reduces financial strain and keeps options open for the future. To summarize, better financial stability as we maintain low leverage and strong coverage ratios, better risk management as we protect against pessimistic outcomes by avoiding heavy refinancing burdens, better future flexibility since Broadway retains capacity to grow or weather downturns with less debt, and lastly, a 3.8% lower ROE is an acceptable trade-off for long-term sustainability. Hence, 50% debt financing is preferred as it offers the best balance of return and risk. From the major risks I've mapped out, we can see that overpayment is our biggest concern, hence our push to renegotiate price. A market downturn could reduce cash flow, so we preserve flexibility through mixed financing. Integration risk can be addressed through clear KPIs and management plans, and over-leverage risk is removed entirely by avoiding the 100% debt scenario. To wrap up, here's our action plan. Broadway should renegotiate the price below $120 million to protect shareholder value and finalize her 50-50 financing mix. We can measure the success based on pricing, financing ratios, synergy realization, and smooth integration. With these steps in place, Broadway is well positioned to become a national leader in the facility services industry in the US.